Welcome back to another session of our second quarter Nedgroup Investments Quarterly Roundup. Joining me now is Linda Eedes from Ford Asset Management. Ford, of course, are the investment managers of our Nedgroup Investments Stable Fund. Welcome, Linda.
Thanks, Mansoor. Good to be here.
Nice to have you in the hot seat. I think our viewers are familiar with you or used to seeing your face, so good to have you answering our questions today. We're going to dive straight into performance. So fund performance for the fund has been quite strong year to date as well as over the past year. And I think what's notable about that is that, despite being a low equity fund, people always think, conservative. It's actually done quite well in a risk-on environment.
Yeah.
Maybe just talk us through some of the numbers.
Well, I think, Mansoor, as you rightly point out, I think that's a very notable aspect of this quarter. The market has gone back to full risk-on. Blink and you would have missed, one of the biggest drawdowns in US history and one of the quickest recoveries. And I think the market is now, sort of assuming that all is well. I think what our returns show over the year to date and over the quarter are that, despite the fact that we do tend to be more conservatively positioned in terms of always being mindful of the risk element, we are actually invested in many parts of the market which are able to deliver those real returns. And in particular on the global side, you've seen that those returns have come from other places, not only the US equity market. So I think that's quite notable for this particular quarter.
Yeah, and if we drill down, I think maybe just, as you alluded to, it's not just come from the US, it's been quite broad-based. From an asset class perspective, as well as, if you drill down to some of the stock specifics, maybe just talk us through some of that stock attribution.
So when we actually look at, let's just start with the asset classes, because I think, even though we've seen the Rand actually strengthen over the last while, foreign assets still are one of the biggest contributors to the absolute returns. Now, if you look at this performance attribution / contribution on the slide, it's actually telling you how much of the absolute returns were made up from each of these segments. So this doesn't speak to how we might have performed, for instance, relative to the market or peers, for instance. So I'm going to talk a little bit to both of those aspects because I know that obviously investors are wanting to have a bit of information about both. From an absolute perspective, we still got a big contribution from the foreign assets. And I think there the notable thing is that, it wasn't just one horse in the race. Over the last few years, it's been US equities. And the market is starting to challenge the narrative that there is no alternative to US equities. So actually, if you look at, for instance, the MSCI All Countries World Index, what's interesting is that over the year to date, it's up, I think, about 6% over the year to date. But if you look at it in euros, not in US dollars, it's actually down 4%. And I think part of the reason why we actually had contributions from the foreign assets, quite strong contributions, is that our portfolio is leaning away from the US, and it has equities and other assets in many other areas as well. Of course, we also saw some strong returns coming from the local bond market and, of course, other aspects as well as JSE equities even. But from a relative perspective, I would say that we are a little bit more cautious on our South African bond position. We do tend to have a little bit more in the middle of the curve rather than the longer dated bonds, which actually saw yields move down the most. So if you compare us, for instance, maybe to a manager who has a lot more bonds further along the curve, we would have lagged a little bit. But there are good reasons for that. We also have more inflation-linked bond exposure, and we're going to talk a little bit more about that later on in the presentation.
Thanks for that, Linda. One of the things that sticks out for me on the slide is Aspen, of course. During the quarter, it's gone through some of a bit of a tough time, bit of a caution coming out of the company. Maybe just talk us through some of the actions that you've done around Aspen.
Yes, Mansoor, of course, that was a disappointment to us. The dispute around the Moderna contract was as much a surprise to us as it was to the management team. So unfortunately, that does impact their sort of earnings over the next year or two. Of course, the market did react quite strongly to that. And on a sum of the parts basis, the stock is now trading at a discount. So we've kept that holding in the portfolio. We're comfortable that they will be able to fill that capacity, but unfortunately it does impact their medium term over the next year, 2-3 years. But nonetheless, that's why we have many different investments in the portfolio. Occasionally something does catch you unawares, but you need to have a portfolio that obviously can weather the storm. And at the same time, we did have many other things, for instance, such as gold, which actually performed very well during the time that Aspen came off in April. So that helped to bolster the returns and give us a good return overall nonetheless.
Indeed, I think it always helps when you have a manager such as Ford, places a strong emphasis on managing that downside risk. So that always helps when you have, things like this pop up.
Absolutely.
And I'm quite keen to get into your macro views now, because listening to Ford's macro is always very interesting. One of the common themes today, of course, has been, same with the US, Trump's big, beautiful bill that's been making headlines. It's been a big win for him and his support base. What's your thoughts on the impact on the US economy and their budget?
Well, Mansoor, the big, beautiful bill was also the reason for the big, beautiful breakup between Musk and Trump. Of course, the big bromance, and I think we, siding with Musk on this one. Of course, if you look at the slide, the Congressional Budget Office anticipates that it's going to add about $3 trillion to US debt, which is already growing at a faster pace than US GDP. And already the interest expenses on debt for the US are around 20 cents to the dollar, which is kind of around the levels that you expect from emerging markets, such as South Africa, for instance. So they're taking a big gamble that the tax cuts will obviously boost the economy sufficiently to actually offset the impact of that. But at this stage, the estimations are that the debt to GDP will end up being around a 7% deficit. So that is really very, very concerning for us, because they're already in a quite precarious situation from a fiscal perspective. And that means that they've got a lot less ammunition if the economy comes under strain. So usually you see these kind of deficits in a very difficult economic environment. It means that if they do need levers to pull, if there's a marked slowdown, given all the tariff announcements and the likes, this is one less that they've got, in their ammunition.
Yeah, and we've already seen that downgrade in the US credit rating as well.
Correct.
So all of that feeding into that. The other side of the big news this quarter, of course, has been tariffs, and a big player or a big, target of US tariffs, of course, has been China. We've already seen them try to reroute their exports, try and move manufacturing into other areas, such as Mexico, which again, Trump is trying to counter. Yeah. What are your thoughts here, please?
So if you look at the slide, the point that we're trying to make here is, if you look at who is better positioned between the USA or China, we'd argue very strongly that China is in a much better position to actually hold their ground. First of all, the consumer's in a much better position. If you look at the household saving rate, it's far higher than the US and Europe, which means that there's quite a lot of internal ammunition for consumers to spend more for the consumer-oriented segment of the economy. In other words, domestically, for economic growth to come through that, rather than being reliant on the external side. And then also, they're sitting in a trade surplus, if you look at the graph on the right-hand side, which puts them in a much stronger position in terms of being able to stimulate the economy if they have a slowdown. Of course, China's still growing at quite a fast clip. It's slowed, but it's still growing at about 5% per year, which obviously is quite something, given that it's the second biggest economy in the world. And if you kind of compare the exports that go to the US as a percentage of GDP in China, it's actually come down to 3%. If you look as a percentage of total exports, the US is around 15%. So China's gone through quite a process of actually increasing its trade with many other partners besides the US. So it doesn't face an existential risk due to the US alone. And for all those reasons, we actually think China's in a pretty good position to weather the trade tariff storm.
And that sounds quite positive. Turning to, I think, on the fixed income side of things now, the fund has an inflation +4 target. Inflation in SA for many years has been quite elevated, and it's been quite a high bar to reach that target. I know you and your team, there's a high bar for selecting assets that goes into the fund. One of those asset classes that you've selected is ILPs, of course. Maybe just give us your thoughts into, around ILPs as an asset class and where valuations are and why you like them so much.
Right. Well, we've actually increased our exposure to inflation-linked bonds quite significantly. The main reason is, if you look at this chart on the left-hand side, this shows in orange the real yields for 5-year inflation-linked bonds, and you can see that those are sitting at around 5%. Now, if the objective of the fund is to reach a CPI +4% target, and you look at the break-even rates, now this is a bit of a technical term, so I want to explain what we're looking at here. On the right-hand side, it says SA break-even rates. Now you can see those are trending down close to 3.5%. What that means is that if inflation turns out to be higher than 3.5% over the next 5 years, inflation-linked bonds will actually outperform nominal government bonds. So what you've got is a combination, and we think, by the way, that that's quite likely because we're seeing, very low inflation rates at the moment, which is why, of course, the Reserve Bank wants to bring in inflation targeting at this point in the cycle. But it's unlikely that it's going to stay at such low levels. It probably will start to creep back up closer to 4 or 5% over time. So we think now is a really, really great opportunity to actually put that component into the portfolio, which gives you 5% above inflation in terms of the yields, but also protects you against, a saver's worst enemy, which is inflation, if that turns out to be much higher down the line. So now in terms of the bond portfolio, which is about 25-26% of the portfolio, in the high teens, we've got inflation-linked bonds because of this very compelling risk-return opportunity.
Indeed. Just staying with valuations for a second. On the global equity valuation side, despite some volatility, it seems there's some complacency in the market as well. If we look at the US, it just seems to have shrugged off all of these concerns, and it just seems to make high after high after high, and it's expensive for a reason. Is the US expensive for a good reason, in your opinion? Is that where we should be looking at, or should we turn our attention elsewhere?
That's a good question. Is it expensive for a good reason? Yes, it's expensive for a good reason, which is that for a long period of time, as I said before, the US was really the only place to put capital. And everybody agreed because, of course, the US was leading the tech race. Of course, the US economy fared far better when we had, obviously, inflation creeping back up. The central bank has done a very good job of actually causing that inflation to moderate somewhat. So there were good reasons why valuations were where they were. And of course, the companies, the Magnificent Seven, are fantastic businesses, continuing to do incredibly well. Should they still be at these levels? I think if you look 6 months ago when they were last at these valuations, you didn't have all the tariff disruption, for starters. The AI narrative was not being questioned in terms of the US being, sort of undisputedly the market world leader. Now we've had obviously DeepSeek coming, challenging that narrative. So I don't think anyone can say it's a dead cert that the US will lead the AI race. And of course, I think everybody expected that Trump's second term would be very much like his first. So, I think that if you look across the board, one can't really argue that risks are lower than they were 6 months ago when we were last at these levels. And for us, we love the underlying fundamentals of the businesses there, many of them which have done so well. But we're finding similar businesses in terms of those great quality fundamentals, great cash flow generation, growing earnings, but at much more attractive valuations. And, we can't be entirely, we can't entirely ignore the price that you pay for those future cash flows, because that will have an impact on your returns. And I think what the market showed over the year to date is that those opportunities are actually there elsewhere. So we prefer to actually invest in a far wider opportunity set, not only because we think there are great opportunities there, but because that also protects against downside risk. And Mansoor, as you know, we have an objective to have no negative returns over 12 months rolling, but we've still got to get those CPI plus 4% returns. So that's what we're doing.
Indeed, making those starting valuations all the more important.
Correct.
Bringing all this all together, could you please share how Ford are positioning then the portfolio, sort of given this outlook and in this environment?
Well, I think if you actually look at the asset allocation, one of the important points is that, we're very, very close to the max equity exposure. So you're just under 40% if you actually add the JSE equity exposure and the foreign equity exposure. And what that's telling you is that we are finding opportunities out there. So we're excited about the real return opportunities that are available to us. That broadening of that opportunity set is great because you can see it starting to come through there. And I think this really speaks to our strength as a business, which is that, we've been around for more than 40 years. One of the things that has made our investment approach successful is that, we want to steadily and surely put the numbers on the board, but we don't want to do that by taking excessive risk. So if you can do that and not get derailed along the way, you've got to obviously survive and make sure you give a stable return path to your investors as possible. Then you will get a very good outcome over time. And this fund has, of course, produced very good outcomes for investors over the longer term. Over the shorter term, sometimes we'll lag peers if that risk on trade comes with an inordinate amount of risk in our mind. But there are a broadening opportunity set of opportunities out there, but we do still have a little bit of cash because that market volatility gives us great opportunities to buy businesses when the baby gets chucked out with the bathwater in the fund going forward.
Always keeping your options open. I like that. just to sum up in total, are there any points that you would like to summarize, just giving a view, or any additional points that you'd like our viewers to know?
Yes, I think, what I like about this fund is that it really is a safe pair of hands. I mean, Ford as a business has always paid a lot of attention to managing risk, making sure, as you say, that we are protecting against the downside. But you've also got to give investors the returns that they need, and you've got to grow their capital meaningfully over time. So if you look at the portfolio, we've got a very nice blend of global and local high-quality businesses trading at good valuations. We've still got some gold because there's still a lot of uncertainty on the geopolitical front. We've got a bit of cash, which is exciting because it's what we can put to use when market opportunities come out. And we do think that you have to be highly selective in this environment, particularly in South Africa, where we can't count on economic growth coming through. So again, just that top-down process, looking where the macroeconomic risks are, but marrying that with bottom-up, high-quality opportunities, trading at prices that make sense.
That totally makes sense. Linda, we'll leave it at that. We appreciate your insights and your time today. Thank you so much for joining us.
Thanks, Mansoor, for having me.
Thank you. And on that note, that brings us to an end to our second quarterly roundup. We do hope you enjoyed all the insights brought to you by our best-of-breed investment managers. Should you require more information, please reach out to Nedgroup Investments. And until next time, take care and goodbye. Thank you.